You know, usually when we evaluate a company's quarterly earnings report, there is this baked-in expectation of just like simple arithmetic.
Right, yeah, like a straightforward math test.
Exactly. We tend to look at financial statements the way we look at, I don't know, the scoreboard at a basketball game.
You look up and check the score?
Yeah, you look up, you check the top line revenue, you scan down to the net profit, and you generally assume you know exactly who is winning and who is losing in a given sector. I mean, we like things to be clean, you know, visible, easily categorized in neat little spreadsheet columns.
Oh, absolutely. It's comforting to treat corporate performance as a binary exercise. Like the line goes up, which means the company is healthy, or the line goes down, which means the whole investment thesis is broken.
Right.
But when you step into the world of these massive foundational technological shifts,
Like generative AI.
right, like the transition from traditional mobile internet to generative AI, when you do that, that simple scoreboard becomes completely inadequate. It just doesn't work anymore. We are looking at a corporate and financial landscape today that is incredibly deceptive if you're only willing to look at the surface level aggregates.
It is the absolute definition of diagnostic muddy waters for investors. And, well, that is exactly why we are here today. So, welcome everyone to this Talk Ticker style deep dive.
Glad to be here.
And if you are joining us, you already know our mission. We take the raw, unfiltered data from corporate disclosures, and in this specific case, we are cracking open the transcript from Baidu's Q1 2026 earnings conference call.
A very dense transcript, I might add.
Highly dense. But we are going to cut through the Wall Street jargon, bypass the standard public relations spin, and deliver the hard data, the vital context, and most importantly, the actionable takeaways for your portfolio.
Because we want to focus on what actually drives long-term enterprise value, not just the noise.
Exactly. So reading the headlines on this specific earnings release, I mean, it's a surefire way to miss the actual story.
Oh, completely. The superficial metrics, they tell a tale of this stagnating tech giant, you know, but the underlying segment data reveals a really violent internal transformation.
Yeah, violent is a good word for it. Let me just give you the hook right out of the gate. The single data point that fundamentally shifts the investment thesis for this entire company. Are you ready?
Let's hear it.
Baidu is no longer just a search and advertising giant. For the very first time in the company's history, their artificial intelligence segment is officially the majority of their core business.
Which is huge. I mean, crossing that 50% threshold is a watershed moment for literally any legacy technology company.
That changes the identity of the stock.
It does. It indicates that the new technology is no longer just an experimental side project, right? Or some speculative bet on the future. It is the primary engine of the current enterprise.
The primary engine. I love that. So we need to open the ledger and look at the headline numbers to see exactly how this transformation is just hiding in plain sight.
Let's do the math.
Yeah. Let's start with the top level view, the aggregated numbers that, you know, the high-frequency trading algorithms react to in the very first millisecond of the press release.
The ones that trigger all the initial buy and sell orders.
Right. So Baidu's general business revenue for Q1 was RMB 26.0 billion. Now that represents a year-over-year growth of just 2%.
2%, yeah.
Which management noted this was a return to positive growth after some prior declines. But objectively, 2% is a very modest number.
Modest is being polite.
Fair enough. In the context of the broader tech sector, it barely beats inflation in certain markets.
Right, because 2% top-line growth is what the market expects from like a mature, perhaps even stagnating legacy utility company.
Like a water company or something.
Exactly. It certainly does not align with the valuation multiples typically assigned to cutting-edge technology platforms. When institutional investors see 2% growth, their immediate assumption is, well, market saturation or a loss of competitive advantage in the core product.
And looking at their profitability metrics kind of reinforces that image of a mature, slow-moving business. The non-GAAP net income attributable to Baidu came in at RMB 4.3 billion.
Which translates to a non-GAAP net margin of 14%.
14%. That is a solid, defensible margin. It means they're definitely profitable, but again, it is steady rather than spectacular.
Right. It doesn't scream hypergrowth.
No, it doesn't. And then we have to factor in the anchor that is currently just weighing down the overall financial picture, which is the IQII entertainment segment.
Ah, yes, their online video and streaming entertainment service.
Which is struggling.
Well, the economics of the entire streaming industry have become brutally difficult globally. I mean, it's characterized by these sky-high content acquisition costs and really intense subscriber chain.
People jumping from platform to platform.
Right. And IQIY is clearly not immune to those macro pressures.
Not at all. IQIYI dropped 8% quarter over quarter, pulling in RMB 6.2 billion.
So it's shrinking.
It's shrinking. So let's compile that surface level view for you. You have a flat legacy search and advertising business growing at 2%, paired with a declining streaming entertainment business shrinking by 8%.
It doesn't sound great when you say it like that.
It sounds terrible. If an investor stops reading the earnings report right there, the logical conclusion is to sell the stock, allocate that capital elsewhere, and write off the company as some relic of the Web 2.0 era.
But, and this is a massive but, making that decision based solely on the aggregates ignores the tectonic plates shifting underneath the company's organizational structure.
This is where it gets good.
Yeah, the narrative completely inverts when we isolate the new AI-focused segments from those legacy businesses. Management revealed a specific revenue breakdown that is, frankly, the most critical piece of financial data from the entire hour-long call.
Okay, lay it out for us.
So revenue from what management classifies as their core AI-powered business.
Which operates entirely outside of traditional online marketing and search.
Exactly, completely separate. That revenue hit RMB 13.6 billion for the quarter.
Wow.
And that represents a massive 49% year-over-year jump.
49%. I mean, achieving 49% year-over-year growth on a base of over 13 billion RMB is a staggering acceleration.
It's huge. It demonstrates that the demand for their enterprise AI solutions is not just theoretical anymore. It is translating into massive, highly recognizable revenue today.
Right now.
Right now. And because of that explosive growth rate, that AI-powered business now makes up 52% of Baidu's general business revenue.
Over the halfway mark. Think about the mechanics of that 52% crossover, everyone. If you just look at the 2% total revenue growth, you see a station wagon.
A slow, heavy station wagon.
But that 49% AI growth hiding under the hood, it means the propulsion system has been entirely replaced. It's like finding a Ferrari engine inside that family sedan.
That's a great analogy. The legacy business, the search, and the streaming is actively masking the hypergrowth of the future business.
It's hiding it. So when we drill down into the specific components of that AI revenue, the numbers become even more concentrated, don't they?
Oh, absolutely.
Let's examine the cloud computing metrics they provided, because AI revenue is kind of a broad umbrella term that requires some serious unpacking.
Right, because the majority of that revenue velocity is actually being generated by their cloud infrastructure. Baidu reported that their AI cloud infra segment grew by 79% year over year.
79%. And just to put that in perspective for you, the broader global cloud computing market is growing at a fraction of that rate.
A tiny fraction. But housed inside that 79% aggregate cloud growth is an even more intense concentration of demand.
The GPU cloud segment specifically. That segment skyrocketed by 184% year over year.
184%.
That is nearly tripling a massive, highly capital-intensive infrastructure business in a 12-month period.
It's almost unheard of at that scale.
It is.
Yeah.
We need to pause here and translate the underlying technology for you, because the architectural distinction between standard cloud computing and GPU cloud computing, it dictates the entire economic reality of the tech sector right now.
It really does. So for the last decade and a half, the traditional cloud computing market, the infrastructure that legacy tech companies relied on to build the modern internet, that was built on central processing units or CPUs.
The brains of a standard computer.
Exactly. And the architecture of a CPU is designed for sequential processing. It's incredibly efficient at handling logic, running traditional databases, serving web pages, and executing standard conditional operations.
Like the if this then that code that powers most basic software.
Right. It does one thing very fast, then the next thing, then the next.
But artificial intelligence, specifically the process of training and running inference on large language models with billions of parameters, it does not work sequentially.
Not at all.
You cannot process a neural network one calculation at a time.
Yeah.
The latency would make the system completely unusable. AI requires processing millions or even billions of calculations simultaneously.
It relies on matrix multiplication.
Matrix math.
Yeah.
And that requirement for parallel processing is exactly what graphics processing units, or GPUs, were originally engineered to handle.
Yeah, which is kind of funny when you think about it. Originally, they were designed to render millions of pixels on a screen simultaneously for complex video games or 3D rendering.
For gamers.
For gamers. But it was this fortuitous coincidence that the exact same parallel architecture required to calculate, lighting and geometry for a pixel on a screen. It's mathematically identical to the matrix math required to adjust the weights and biases inside an artificial neural network.
Which is just wild.
It is. So when modern enterprises want to build, fine-tune, or deploy generative AI, they do not rent CPU cloud space. CPU space is functionally useless for these workloads.
They absolutely require GPU cloud space.
100%.
So what this 184% growth figure tells us is that the enterprise demand for that highly specialized parallel compute architecture is absolutely voracious.
Voracious is the perfect word. And the transcript noted that this growth actually accelerated from the 143% growth they posted in the previous quarter.
So the adoption curve is steepening, not flattening.
Exactly. It's speeding up.
Yeah.
And taking a step back to analyze these percentage jumps, 49% overall AI growth, 79% AI cloud growth, 184% GPU cloud growth, we have to recognize that scaling physical infrastructure at this speed requires extraordinary operational execution.
Yeah, it's not just the software update.
No. You do not accidentally triple a cloud segment that requires immense power provisioning, highly advanced cooling solutions, and incredibly complex networking topographies.
Right, you cannot just buy a bunch of GPUs, plug them into a standard data center server rack, and expect them to work.
They would literally catch fire.
They would. The power density and the thermal output would melt a traditional server room, and the networking bottlenecks would render the GPUs idle while they just wait for data to arrive.
Which is a massive waste of capital.
Huge waste. This brings us to the operational reality of what is actually generating this revenue. We know the high-performance engine is installed, so let's look at how they built it.
Okay, so the foundational thesis presented by Baidu's management revolves around what they term their full stack advantage.
Full stack.
Right. Now, this phrase is heavily utilized in Silicon Valley marketing materials. It's often loosely applied to any company that just bundles a couple pieces of software together.
It's a major buzzword.
It is. So we need to rigorously define what full stack actually means in the context of Baidu's infrastructure, because it is the primary economic moat protecting those crazy growth rates we just talked about.
Yeah, because every tech company claims to have an integrated ecosystem, or like an end-to-end solution. I really want to push on this concept.
Go for it.
What does full stack mean operationally for Baidu that fundamentally separates them from a competitor who simply, purchases GPUs from a hardware vendor, racks them in a leased data center, and resells the compute time to developers?
The distinction lies in proprietary ownership of the underlying technology at every single vertical layer.
Every layer.
Every layer. When Baidu says full stack, they mean they have engineered customized components starting from the absolute base layer of the technology stack and moving all the way up to the consumer-facing application. They are not merely aggregating third-party vendor solutions.
Okay, let's start at that foundational layer then, the underlying silicon. Baidu isn't just buying off-the-shelf chips from the dominant global designers.
No, they aren't.
They have invested heavily in developing their own proprietary AI accelerators known as the Kunlunxin chips. Management specifically highlighted that Kunlunxin has achieved large-scale commercial deployment. They cited a single AI computing cluster operating with over 30,000 of these accelerators networked together.
30,000 chips. I mean, the engineering complexity of networking 30,000 advanced chips together so they act as a single, unified computational brain, it cannot be overstated.
Explain why that's so hard.
Well, in traditional computing, data mostly travels what we call north-south, meaning in and out of the server to the end user.
Like downloading a file.
Right. But in AI model training, the data traffic is almost entirely east-west, meaning the chips are constantly talking to each other, synchronizing weights, and passing massive data sets back and forth internally. If the networking fabric bridging those 30,000 chips has even a microsecond of latency, the entire cluster bottlenecks and the computational efficiency just plummets.
It grinds to a halt.
Exactly. Successfully managing the optical transceivers, the networking switches, and the physical heat dissipation for a cluster of that magnitude is a massive barrier to entry.
And owning that silicon layer provides a profound financial and strategic advantage. Because Baidu controls the design and production pipeline of Kunlunxin, they possess an internal lever to completely optimize their capital expenditures.
Right. They aren't at the mercy of outside vendors.
Exactly. They are not entirely subject to the pricing power of external chip monopolies, nor are they as vulnerable to the volatile, geopolitically sensitive global supply chain that dictates hardware availability for most of their competitors.
And furthermore, they are monetizing the silicon beyond just their internal usage.
They're renting it out.
Yeah. The earnings transcript confirms that Kunlunxin infrastructure is open and validated for external clients running various mainstream foundation models. They explicitly noted that the chips support high-efficiency inference for major Chinese models like DeepSeek V4, GLM 5.1, and Minimax M2.7.
Wait, so this means competing AI developers are stress testing Baidu's proprietary silicon, evaluating the cost-to-performance ratio, and concluding that this infrastructure is reliable enough to run their own core commercial products.
That's exactly what it means, and that totally validates the silicon layer.
It's proof it works at scale. Okay, moving up the stack, above the hardware and the networking, we reach the model layer. This is the actual algorithmic brain of the system.
The foundation model.
Right. For Baidu, that is the Ernie foundation model, and they dedicated significant time to their newest iteration, Ernie 5.1.
Which is important because evaluating the actual intelligence of a foundation model is notoriously difficult.
So much spin.
Right. Companies often selectively publish benchmarks that just happen to favor their specific architecture.
That's a shocker.
Right. However, the call highlighted third-party validation from the LM Arena.
Oh, I know LM Arena.
Yeah. It operates as a crowdsourced blind A/B testing platform. It uses an ELO rating system similar to chess rankings based on thousands of blind human evaluations comparing model outputs side by side.
No bias, just head-to-head results. And according to this independent benchmarking, Ernie 5.1 ranked first among all Chinese models on the text leaderboard.
Number one.
That's impressive. The architecture behind Ernie 5.1 likely utilizes a mixture of experts' approach, combined with highly curated pre-training data and rigorous reinforcement learning from human feedback to achieve that level of nuance in its outputs.
And it wasn't just text. The transcript also highlighted that Ernie 5.1 topped the LM Arena search leaderboard among Chinese models, and critically, it ranked fourth globally on that same search metric.
Fourth in the world.
Yeah. Being the only Chinese model to penetrate the global top tier for search integration, it really demonstrates the maturity of their model architecture.
It absolutely does.
Yeah.
Now, having proprietary silicon and a top-tier foundation model is an incredible feat of engineering. However, as an investor analyzing cash flows, the critical question is how these engineering milestones translate into high-margin revenue.
Show me the money.
Exactly. Baidu is not content to just sell the picks and shovels during this AI infrastructure build-out. They are actively developing the real-world applications built on top of the Ernie model.
This brings us to the top layer of the stack, the application layer.
Right. Management was very explicit on this point, stating their belief that the true, durable value of artificial intelligence will ultimately be captured at the application layer.
They are executing what they describe as an application-driven approach. It's shifting the paradigm from selling raw compute to selling solved business problems.
Which is much more lucrative. The CEO spent considerable time discussing the transition into the agentic AI era.
Agentic AI.
Yeah, that phrasing sounds a bit academic, so let's unpack the mechanics of it. What separates an AI agent from the chatbots we've all become accustomed to over the past couple of years?
It's a huge difference. The shift from passive chat interfaces to agentic AI represents a fundamental evolution in software architecture. Well, a standard large language model is generally stateless and synchronous. You type a prompt, it generates a probabilistic response based on its training data, and then it just stops.
It's done.
Right. It forgets the interaction entirely unless you feed the context back into it, and it waits passively for your next command.
But an agent is different. An agent, by contrast, is designed to be autonomous and stateful. It is equipped with memory architectures, allowing it to recall previous interactions and user preferences.
And more importantly, an agent is granted access to external tools.
Like what?
Like it can make API calls, it can search live databases, and it can interact with other software systems without you holding its hand. You don't give an agent a prompt, you give it an objective.
Okay, the transcript highlighted a newly launched tool called Domate to illustrate this. Management categorized Domate as a 247 background AI assistant aimed at enterprise and everyday productivity.
And Domate operates asynchronously, meaning you can assign it a complex multi-step workflow. For example, you could say, monitor these 3 competitor websites, cross-reference their new product launches with our internal supply chain database, and draft a risk assessment report by tomorrow morning.
That's a lot of steps.
It is. But the agent takes that overarching objective, uses chain of thought reasoning to break it down into sequential subtasks, executes the necessary API calls to gather the data, synthesizes the information, and completes the task while you are focused on totally other work.
That is incredible. And the CEO emphasized that because Domate is stateful, it learns the specific operational rhythms and preferences of the user over time.
It gets better the more you use it.
Right. From a business perspective, that deep personalization creates an incredibly sticky product.
Extremely sticky. Once an enterprise integrates an autonomous agent that deeply understands its internal workflows, the switching costs become astronomically high.
Nobody wants to start overtraining a new AI.
Exactly. Churn rates plummet because replacing the agent means losing all that accumulated institutional knowledge it has developed.
Okay, so that covers white-collar digital productivity. But the transcript also detailed an agentic application deployed in the physical world, which introduces a completely different level of complexity.
Oh, this was fascinating.
Right. Management discussed the deployment of Famo Agent, specifically version 2.0, at the Qingdao port.
And just for context, the Qingdao port is one of the largest and highest volume shipping hubs globally.
It's massive.
The operational logistics of managing a megaport like that represent a classic combinatorial optimization problem.
Okay, plain English, please.
Right, sorry. It means you have a massive number of moving parts. You have huge cargo vessels arriving with varying schedules, fluctuating weather and tidal patterns, and tens of thousands of shipping containers that must be unloaded, sorted, and routed to specific ground transportation networks.
It's controlled chaos. And traditionally, ports manage this chaos using highly sophisticated software, relying on linear programming and rigid operational heuristics.
Strict rules.
Strict rules. But traditional software struggles when the number of interdependent variables just explodes.
Right, like if a storm delays 3 ships.
Exactly. A legacy system using rigid rules might bottleneck, requiring human domain experts to manually intervene and reorganize the crane schedules and berth allocations.
And that takes time and money. Famo Agent 2.0 addresses this by layering a self-evolving AI directly over the port's existing software infrastructure. Instead of following static heuristics, the agent utilizes deep reinforcement learning to autonomously explore the solution space.
So when variables change a delayed ship, a broken crane, the agent simulates millions of potential scheduling permutations in real time.
Millions of them.
Optimizing for efficiency across the entire port ecosystem simultaneously.
Yes. It calculates efficiencies that are literally mathematically invisible to human operators and rigid algorithms.
Wow.
And critically, Famo Agent provides a natural language interface.
So you could just talk to it.
Yes. A logistics manager does not need to write complex database queries to adjust parameters. They can simply tell the agent, prioritize the perishable cargo on vessel A and route it to the northern rail depot. And the agent recalculates the entire port's operational math to execute that command optimally.
That is a massive real-world application. All right, moving from physical logistics to consumer engagement, the transcript also highlighted their advancements in digital humans.
This is a huge market.
It is. This application targets the massive global live commerce and e-commerce sectors, where brands rely on human hosts to broadcast live, demonstrate products, and interact with viewers to drive immediate sales conversions.
And managing human talent for continuous live streaming is expensive.
And difficult to scale. People need to sleep.
Right. So Baidu's digital humans are hyper-realistic digital avatars designed to take over these broadcasting roles.
And the key financial takeaway here is not just the aesthetic improvement of the avatars, though they do look great. It is the radical restructuring of the unit economics. Management revealed that the cost to deploy these digital humans has plummeted by 80% over just the past 2 quarters.
80% in 6 months. An 80% cost reduction fundamentally alters the market for a technology.
It changes everything.
It transitions the product from an expensive, bespoke marketing stunt used only by major brands into a highly scalable, accessible utility for small and medium-sized merchants.
The mechanics behind that cost drop are fascinating too. They are likely moving away from traditional 3D rendering pipelines, which require massive computational power for lighting, rigging, and rendering every single frame, and utilizing advanced neural rendering techniques.
Like neural radiance fields or latent diffusion models?
Exactly. These generative techniques synthesize the video output directly, requiring a fraction of the compute cost while maintaining real-time latency for live interactions.
Furthermore, they have aggressively internationalized this application.
This is key.
They launched an overseas platform that natively supports 24 different languages, including Spanish, French, and Thai.
And management emphasized that this is not merely audio translation, right?
Right, no. The underlying multimodal models ensure deep cultural localization.
So it aligns the avatar's body language, micro-expressions, and conversational tone with the target demographic.
Exactly. So a merchant based in Shenzhen can spin up a localized digital avatar, feed it a product sheet, and have it broadcast live to a market in Paris, speaking flawless French with culturally appropriate mannerisms.
24 hours a day.
For a marginal fraction of the cost of a human marketing team.
Unbelievable. So these enterprise agents and digital avatars are driving immediate high-margin software revenue. But we must address the physical hardware application that represents the most ambitious aspect of Baidu's AI strategy.
The robo-taxis.
Yes. The earnings call dedicated substantial time to the milestones achieved by Apollo Go, their autonomous ride-hailing service.
The headline metric for Q1 was 3.2 million fully driverless rides completed.
3.2 million. They are sustaining triple-digit year-over-year growth in ride volume.
Which is fantastic.
However, the most consequential phrase in the entire transcript regarding Apollo Go was the confirmation that they have officially achieved unit economics break-even in the city of Wuhan.
And let's be clear, reaching unit economics break-even is the critical validation point for the entire autonomous vehicle industry.
It's the holy grail.
It is. For the past decade, AV development has essentially operated as a heavily subsidized research and development exercise. The capital expenditure required for sensor arrays, localized edge compute, and the massive data centers required to train the driving models, it was astronomical.
More importantly, the operational costs of each individual ride were deeply negative.
They were losing money on every trip.
A lot of money. In the early stages, the cost of the LiDAR sensors, which used to run upwards of $75,000 per unit for those mechanical spinning arrays, combined with the necessity of having remote human operators monitoring almost every vehicle on a 1-to-1 ratio, it meant the company lost significant money every time a passenger hailed a ride.
Right. So achieving break-even on a per-ride basis means the revenue generated by the passenger fare in Wuhan now fully covers the direct operational costs of that specific trip.
That includes vehicle depreciation, the electricity to power the car, insurance, maintenance, and the cost of the remote operations center.
This milestone was achieved through a really relentless compression of the cost curve.
How did they do it?
Well, they have transitioned to much cheaper solid-state LiDAR systems. The edge compute hardware inside the vehicles has become commoditized, but most crucially, the underlying AI driving model has become sophisticated enough that the disengagement rate—
That's the frequency with which a human must intervene, right?
Yes, exactly. That disengagement rate has plummeted. So a single remote operator can now monitor a large fleet of vehicles simultaneously, drastically lowering the labor cost per ride.
It is also vital to recognize the operational environment here. Wuhan is not a geofenced, neatly gridded suburban test track.
No, it's a real city.
It is a massive, complex, geographically challenging urban center. Management emphasized that they are now successfully managing the profound system and operational complexities that only emerge when integrating an autonomous fleet into a chaotic, real-world public transportation ecosystem at a massive scale.
They actually cited a specific partnership with Car, Inc. in Hainan, where they stationed fully driverless vehicles directly at the arrival terminal of the Haikou airport.
Which is huge. Integrating autonomous dispatch with airport arrival logistics proves the absolute operational maturity of the platform.
It's not a pilot program anymore.
No, it's a real business.
Okay, so we have established that the technology works and the core applications are scaling rapidly. But public markets price equities based on discounted future cash flows, not historical achievements.
We need to look forward.
Exactly. We need to analyze what management signaled about their future financial trajectory.
So the primary concern for analysts regarding this massive pivot toward AI infrastructure is the impact on corporate margins.
Because it's expensive.
Very expensive.
Yeah.
Historically, when a legacy software or internet company attempts to build out heavy, capital-intensive hardware infrastructure, their profit margins contract severely during the transition period.
It usually tanks the stock for a few quarters. However, Baidu's CFO provided forward-looking guidance that directly countered that historical trend.
He did.
He stated that as the GPU cloud segment continues to outpace the legacy CPU cloud and becomes a larger overall percentage of the revenue mix, the blended margins for the entire cloud business will structurally improve. He categorized this as a durable, ongoing trend. And the economics supporting that structural margin improvement are grounded in the specific dynamics of the AI compute market.
Walk us through that.
Firstly, deploying and managing high-performance GPU clusters involves incredibly high technical barriers to entry.
As we discussed with the networking and thermal issues.
Right. The complexity prevents new entrants from simply commoditizing the service and driving prices down.
Secondly, there is a profound macroeconomic supply and demand imbalance. The enterprise demand for training and running inference on large language models far exceeds the available supply of stable, high-performance GPU compute.
Demand is way higher than supply.
Way higher. And when demand outstrips supply for a critical inelastic resource, the supplier gains immense pricing power. Enterprise clients training models that cost tens of millions of dollars are not price-sensitive in the traditional sense.
They just want it to work.
Exactly. They prioritize infrastructure, stability, and performance over marginal cost savings because a hardware failure mid-training run is catastrophic. It wastes millions.
And finally, that full stack advantage we detailed earlier provides deep internal levers for cost optimization. Because Baidu engineers the silicon, writes the compiler software, and designs the foundation models, they can optimize the inference costs across the entire vertical stack in a way that a competitor relying on third-party hardware and software simply cannot replicate.
So structurally improving margins sound fantastic, but we have to address the elephant in the room regarding capital expenditure. Building 30,000 chip clusters and scaling autonomous fleets globally requires billions of dollars in upfront capital.
Real money.
Real money. A critical concern for retail investors is whether Baidu is hollowing out its balance sheet and burning through its cash reserves to fund this aggressive expansion.
But the cash flow metrics provided in the transcript paint a picture of immense financial discipline.
They really do.
Baidu generated RMB 2.7 billion in positive operating cash flow in Q1.
Marking their third consecutive quarter of positive operating cash flow.
Right. So even while funding this massive AI transition, the core business engine continues to generate substantial surplus cash.
And their total cash equivalents, and short-term investments position sits at a staggering RMB 279.3 billion.
Which is a fortress balance sheet.
It is a fortress. But management revealed a highly sophisticated capital allocation strategy regarding how they are actually funding the acquisition of these AI servers and data center buildouts.
Instead of aggressively drawing down their cash reserves to purchase hardware outright, management explicitly stated they are utilizing a mix of financial instruments.
Like what?
Primarily operating leases, financial leases, and low-cost bank borrowings to fund their AI capital expenditures.
Now, the immediate question an investor might ask is, why would a company sitting on nearly 280 billion RMB in cash choose to take on debt or lease equipment?
It seems counterintuitive.
It does. The answer lies in the weighted average cost of capital, or WACC. Because Baidu is a massive, highly stable corporate entity, they have access to debt markets at incredibly low interest rates.
Right. If the cost of borrowing capital is exceptionally low, and the projected return on invested capital for the GPU cloud infrastructure is exceptionally high.
Due to that pricing power we just discussed.
Right. Then it is financially optimal to use cheap debt to fund the hard assets. This allows the infrastructure to essentially pay for itself over time out of the cash flows it generates.
By utilizing debt and leases for hardware, they protect their massive cash reserves. And they're protecting that cash for a very specific, highly shareholder-friendly purpose.
Which is what every investor wants to hear.
Absolutely. Management confirmed they are preserving liquidity to aggressively fund their ongoing share buyback program and to support their newly introduced dividend policy.
This is a really rare combination in the technology sector. Typically, companies experiencing hypergrowth in a new paradigm suspend capital returns to shareholders.
They argue that every available dollar must be reinvested to capture market share.
Exactly. The fact that Baidu is financing an aggressive global AI infrastructure build-out while simultaneously returning significant capital to shareholders via buybacks and dividends, it is a profound signal of financial health and management's confidence in their free cash flow generation.
And that confidence extends directly to their ambitions for the physical world, specifically the international expansion of the Apollo Go robotaxi network.
Going global.
They are.
Yeah.
The CEO noted that while the regulatory environment in China allowed them to achieve the initial scale and prove the unit economics, they are now seeing regulatory frameworks for autonomous vehicles opening up globally, and they fully intend to capitalize on that shift.
The transcript detailed concrete steps in this global expansion.
Where are they going?
Well, they are currently preparing for open road testing in Switzerland. Furthermore, they confirmed that their initial batch of autonomous vehicles has officially arrived in London, where they anticipate beginning testing phases shortly in partnership with ride-hailing platforms like Uber and Lyft.
Wow, London.
Yeah, and they also noted ongoing driverless operations across multiple designated zones in Dubai.
Now, there is a very specific strategic logic behind targeting these international markets. Beyond simply increasing their total addressable market, this expansion is driven by the potential for massive margin expansion through geographic arbitrage.
Geographic arbitrage, exactly. While achieving break-even in Wuhan proves the technological viability, management pointed out that the baseline fare levels for ride-hailing in many Chinese cities are comparatively low.
Fares are cheap.
Right. But the core cost of the autonomous software and the underlying AI model development is a fixed sunk cost.
Once it's built, it's built.
Yes. So when you port that fully developed break-even software to a market like London, Zurich, or Dubai, you are entering regulatory environments where the average revenue per user a passenger is accustomed to paying is exponentially higher.
The software doesn't care if it's driving in Wuhan or London.
Not at all.
But the margin generated by displacing a human driver in a high-wage, high-fare Western market is radically superior.
They also discussed how their operational history in Hong Kong provided the foundational data necessary for the London expansion.
Oh, because of the driving sides.
Right. Both are right-hand drive markets with really dense urban environments. They utilized Hong Kong to train the models on the specific nuances of right-hand traffic flow, allowing them to port that accumulated intelligence directly into the UK market, which significantly accelerates the deployment timeline.
Okay, so we have systematically unpacked the headline financial aggregates. We have detailed the deep technical architecture of their full-stack advantage from the Kunlunxin Silicon and the Ernie 5.1 model up to the agentic applications and autonomous fleets.
We've covered a lot of ground.
We have. We've also analyzed the economics of their margin guidance and their sophisticated debt-to-equity capital allocation. It is time to synthesize this data into the bottom line.
The bottom line. So, taking all the fundamental data, the operational milestones, and the forward-looking guidance presented in this transcript, the analytical conclusion points toward a distinctly bullish long-term trajectory for the enterprise. Very bullish. We are observing the successful execution of a fundamental corporate rotation.
And the concept of a corporate rotation is perhaps the most difficult maneuver to successfully pull off in the public markets. If you examine the history of the technology sector, the graveyard is full of legacy giants good. Companies that absolutely dominated a specific era of computing, recognized the paradigm shift approaching, but ultimately failed to pivot their business model.
Blockbuster, Kodak.
Exactly. They either refused to cannibalize their legacy profit centers, or they just lacked the agility to build the new infrastructure in time.
And those companies inevitably become value traps for investors.
Right.
Their stock looks fundamentally cheap based on historical cash flows, but the business is slowly degrading. Baidu's Q1 transcript proves they are avoiding that fate. They are successfully managing a flat, low-growth legacy search and advertising business, using it as a reliable cash cow, while simultaneously hyperscaling a high-margin, high-growth AI infrastructure and application business alongside it.
So the actionable takeaway for an investor analyzing this stock is mathematical. If you are evaluating a position, you must filter out the noise generated by the 2% top-line growth and the structural decline of the IQII streaming segment.
Those metrics represent the past.
They do. The thesis for owning the equity today is entirely dependent on the crossover event we discussed at the very beginning of the deep dive.
The high-growth AI segments, the 184% expanding GPU cloud, the enterprise software agents, and the increasingly profitable robo-taxi network have officially breached the 50% threshold of the general business revenue.
And because that high-margin segment is now the majority of the pie, the mathematics of compound growth dictate that as it continues to expand at these elevated rates, it will inevitably begin to aggressively pull the aggregate company margins and total profitability metrics upward.
The stagnant legacy business is merely providing a stable floor.
Right. The AI business is the engine dictating the future trajectory. The market often misprices these transition periods because the aggregated data obscures the underlying velocity.
But the underlying financial foundation remains exceptionally strong. They possess massive cash reserves, they generate positive operating cash flow, they are returning capital to shareholders, and they have established a verifiable, data-backed lead in full-stack AI infrastructure and commercial deployment.
All right, let's bring this deep dive to a close with a rapid-fire summary of the mission we accomplished today. We dissected the Baidu Q1 2026 earnings call and uncovered an enterprise successfully executing a massive technological pivot. We verified that artificial intelligence now constitutes the majority of their core business, crossing that pivotal 52% mark. We saw their specialized GPU cloud revenue explode by 184% year over year.
We analyzed how their AI agents, specifically Dumade and Famo Agent 2.0, are moving beyond basic conversational interfaces to autonomously execute complex, multi-step digital workflows and optimize massive physical logistics operations in real time.
We confirmed that Apollo Go robotaxis have achieved the critical milestone of unit economics break-even in Wuhan and are leveraging that software maturity to expand into high-margin international markets.
And crucially, for the financial health of the enterprise, we detailed how management is utilizing cheap debt and financial leases to fund this massive infrastructure build-out, purposefully preserving their fortress balance sheet to actively buy back shares and pay dividends.
But before we sign off, there is one final detail buried deep within the transcript that really requires your attention, as it introduces a fascinating macroeconomic variable.
Right, the geopolitical angle.
Yes. Throughout the Q&A session, management consistently emphasized the internal deployment and the external commercial adoption of their proprietary Kunlunxin AI accelerator.
Which they build themselves.
Exactly. They noted these chips are filling a massive void in the market, while the global supply of high-end, third-party AI compute remains severely constrained. Enterprise customers are validating and adopting Kunlunxin because they require immediate, reliable compute access and cannot source it from the traditional global monopolists.
Well, let's zoom out and consider the broader geopolitical landscape. We are currently witnessing an intensifying global semiconductor supply chain conflict.
It's a chip war.
It really is. Export controls, lithography equipment embargoes, and heavy reliance on highly concentrated foundry choke points in Taiwan are continuously threatening the AI ambitions of technology companies worldwide.
We have spent this entire deep dive analyzing Baidu's advancements in cloud software, sophisticated language models, and autonomous robotics. But the terminal value of an AI company is intrinsically tied to its ability to secure the compute necessary to run its models.
If you don't have the chips, you don't have a business.
Exactly.
Yeah.
Which raises the ultimate provocative thought for you to mull over. Could it be that Baidu's greatest hidden asset, the structural moat that ultimately insulates them from the geopolitical supply chain shocks threatening their global competitors, is actually their quiet, relentless self-reliance in designing and deploying the raw silicon chips that power the entire revolution?
It's a huge question.
If the broader market experiences a severe bottleneck in third-party AI silicon, the company that controls its own proprietary infrastructure stack holds all the leverage. That is a profound strategic advantage to consider.
Absolutely.
Thank you for joining us on this Talk Ticker style deep dive. We hope this rigorous analysis helped you look past the superficial headlines and understand the complex financial and technological engines truly driving the numbers.
It is always a pleasure to unpack the underlying mechanics of these foundational shifts. Continue to look beyond the surface data and question the aggregated metrics.
Until next time, keep digging into the data, keep expanding your understanding of the technology, and we will catch you on the next deep dive.